If you go back to before the COVID, what you see is we have lost considerable strength in the economy. We have fewer people working, and we have a reduced stream of goods and services, and yet the price is much higher.
Navigating a recession can be challenging. Here are the top 5 cash flow assets you need to make it through the recession. 1. Dividend-paying stocks. Investing in dividend-paying stocks can be a lucrative strategy for generating passive income. Unlike stocks that rely solely on price appreciation, dividend-paying stocks provide investors with regular payments regardless of how the overall stock market performs. These dividends are typically distributed on a quarterly basis, providing a consistent income stream for investors. The size of dividends can vary significantly, ranging from just a few cents per share to several dollars per share. When selecting dividend-paying stocks, it is crucial to consider various factors. One of the key factors to assess is the company's dividend yield. The dividend yield represents the percentage of the stock price that is paid out in dividends annually. For instance, if a stock has a dividend yield of 4% and its share price is $100, the annual dividend payment would amount to $4 per share. A higher dividend yield implies a higher return on investment for shareholders. Another essential factor to evaluate is the company's track record of paying dividends. Companies with a history of consistently paying dividends are more likely to continue doing so. This track record indicates stability and a commitment to returning profits to shareholders. Investors can review a company's dividend payment history, looking for consistent or increasing dividend payments over the years. However, it is important to note that dividend payments are not guaranteed. Companies can reduce or eliminate dividends if they face financial challenges or decide to reinvest profits in other business areas. Therefore, investors should conduct thorough research and consider the company's financial health, profitability, and stability before investing in dividend-paying stocks. 2. Bonds. Bonds are financial instruments that allow investors to lend money to the issuer, typically a government or a corporation, in exchange for regular interest payments and the return of the principal amount at the bond's maturity date. Bonds are widely regarded as a relatively safe investment option, particularly during a recession, due to their predictable income stream and potential to preserve capital. One of the most critical factors to consider when investing in bonds is the issuer's credit rating. Credit rating agencies assess bond issuers' financial stability and creditworthiness and assign ratings based on their evaluation. Investors should carefully analyze the credit ratings of potential bond investments to ensure they align with the risk tolerance and investment objectives. Another important factor to evaluate is the maturity date of the bond. The maturity date refers to the specific point in the future when the issuer will repay the bond's principal amount to the investor. Bonds can have short-term, intermediate-term, or long-term maturities. Generally, bonds with shorter maturity dates are considered riskier investments. This is because the shorter-term bonds expose investors to the potential volatility of interest rates and may require reinvestment at potentially lower rates when the bonds mature. Conversely, longer-term bonds provide more stable income over an extended period and are less affected by short-term interest rate fluctuations. In addition to credit ratings and maturity dates, investors should also consider the prevailing interest rate environment when investing in bonds. Interest rates have a significant impact on bond prices and yields. Conversely, bond prices generally rise when interest rates decline, resulting in capital gains. Investors should carefully analyze the interest rate environment and consider the potential impact on bond prices and yields when making investment decisions. 3. Farmlands. Investing in farmland can be a wise decision during a recession. Farmland possesses unique characteristics that make it an attractive investment option. Firstly, it is a tangible asset with intrinsic value, meaning it has inherent worth and can provide a level of stability during economic turmoil. Farmland has 2 primary ways of generating cash flow: rent payments and crop sales. Renting out your farmland to farmers allows you to collect monthly rent payments, providing a relatively passive income stream. This is an excellent option if you prefer not to be directly involved in the day-to-day operations of a farm. To maximize the benefits of investing in farmland, there are some important considerations. Firstly, conducting thorough research is crucial before making any investment. Understanding the local market, evaluating soil quality, and analyzing potential risks are essential. Investing in farmland through a real estate investment trust is another option worth considering. REITs are investment vehicles that own and operate farmland on behalf of investors. This approach allows individuals to participate in farmland ownership without the need for direct involvement in farm management. Lastly, reinvesting your earnings from farmland is a prudent strategy. By channeling the income generated from rent payments or crop sales back into your investment portfolio, you can harness the power of compounding and grow your wealth over time. 4. Investment in commodities. A recession is a period of economic decline characterized by decreased GDP, employment, and consumer spending. During a recession, businesses may cut back on production, which can lead to lower demand for commodities. This can cause the prices of commodities to fall. However, commodities can also be a source of cash flow during a recession. There are a few ways that commodities can generate cash flow during a recession. One way is through dividends. Some companies that produce commodities such as oil and gas pay their shareholders dividends. These dividends can provide investors with a steady income stream, even during a recession. Another way that commodities can generate cash flow is through rent. Investors who own real estate that is leased to tenants can collect rent payments, even during a recession. This is because tenants may still need to live in their homes or businesses, even if they are not making as much money. Finally, commodities can also generate cash flow through royalties. Royalties are payments that are made to the owner of a mineral or other natural resource, even when that resource is extracted or sold. These payments can provide investors with a steady income stream, even during a recession. 5. Gold and silver. Gold and silver have long been recognized as safe haven assets, meaning that they tend to retain their value or even appreciate in times of economic turmoil. Unlike other assets such as stocks and bonds, gold and silver are not easily influenced by inflation or interest rates, which can contribute to their appeal as stable investments. During a recession characterized by a declining stock market and rising unemployment rates, investors often seek ways to safeguard their wealth. This is where gold and silver come into play. These precious metals have historically been perceived as stores of value and wealth preservation tools during uncertain economic times. Their limited supply and intrinsic value make them attractive options for investors looking for safe havens. The increased demand for gold and silver during a recession can drive up their prices, potentially providing investors with a source of cash flow. As more investors flock to these precious metals, their scarcity and perceived value can increase their market prices. This appreciation can benefit those who hold gold and silver assets, as they can sell them at a higher price than what they initially paid, resulting in capital gains. However, it is important for investors considering gold and silver investments during a recession to carefully weigh the risks and rewards. While these precious metals have historically been considered safe havens, their value can still fluctuate and be subject to market forces. It is crucial to conduct thorough research, understand market dynamics, and assess individual risk tolerance before making investment decisions. Additionally, it's important to consider the practical aspects of investing in gold and silver. Investors have multiple options, including purchasing physical gold or silver in the form of bullion or coins, investing in exchange-traded funds that track the performance of these metals, or even buying shares in mining companies. Each option comes with its own set of considerations, such as storage and transaction costs, liquidity, and potential tax implications. In conclusion, navigating a recession requires careful consideration of cash flow assets that can provide stability and income during economic downturns. By staying informed, making informed choices, and maintaining a diversified portfolio, you can position yourself for greater financial stability during challenging economic times. If you like this video, give it a thumbs up. See you in the next video. Thank you for watching.